Okay, good evening, everyone. You are welcome to our class this evening. I want to believe we have a very nice time or day, and hopefully this will be the grand finale for our classes that we began about 8 weeks ago. So that's barely, 2 months ago. And then I'm pretty sure we enjoyed the lectures, and I want to use this medium to wish you a very good success in your exams. And but before we go, finally, I have two main aspects to look into tonight. We started IAS7 yesterday in our last class, and I'm going to explain the basics once more. Then we look at a question to demonstrate that. And afterwards, I will go straight to financial instruments, and we see how we can really, go about that. So yesterday we said I7 applies to statement of cash flows. And the most important thing here is for you to know what constitutes your operating activities, investing activities, and of course, financing activity. And we also established that there are two methods of preparing cash flows. We have the direct method and the indirect method, where you needed to adjust for the profit before taxes, okay? And obviously, that is what your examiner is going to really, sorry, that's what the examiner is going to really capitalize on, okay? And we also said cash is cash on hand, including overdrafts and demand deposits. Of course, cash equivalents are short-term, highly liquid investments that are not readily available to a known amount of cash and are subject to a low or insignificant risk of changes in value. Okay. Now, I also made you to understand that you need to learn this pro forma for cash flows from operating activity, where you have your profit before tax, like I said earlier. So you adjust for your finance cost, income, investment income, depreciation, profits. If you have profits on sale of non-current assets, it will be removed. Loss is going to be added. Okay. Then provisions for increase or decrease, then government grants, increase or decrease in prepayment accruals, and all of that, so that you can have your cash generated from operations. Okay, and of course, you don't forget to increase or decrease in inventory. So we established that when you have increase in inventory, that means I buy more inventories to be a deduction. Okay, decrease, that means I've sold, money has come in, it will be a decrease, it will be added, okay? And then the same applies to my receivables, okay? The same applies to my receivables. If there is an increase, it will be removed, okay? It's only my payable that if there is an increase, you add it back, okay? So that makes a lot of sense. And okay, I've talked about profit or loss and the changes in inventory and all of that. So we need to take a look at that. Now, when it now comes to operating activity, we said we are going to make adjustments for depreciation, finance costs, tax paid, and all of that. So for your tax paid, once you check your, this is your pro forma for the main cash flow, okay? So after you have done your cash generated from operations, you must have done the adjustment. So whatever you have, you do the adjustment for interest paid and tax paid, okay? Then for your cash flows from investing activity, they are more or less like proceeds on sale of PPE, anything that relates to PPE, okay? Sale of PPE, purchase of PPE, interest received, dividend received, okay? So that's what you put under investing activity. Then for your financing activity, it has to be sale of shares, okay? Proceeds from long-term borrowing, lease payment, dividend paid, and all of that. So dividend received will be under investing activity. but dividend paid will be under financing activity, even though some quarters might put them under the same category. Okay. Now, for your analysis of cash and cash equivalent, okay, you also have your cash on hand and in bank this year and last year. Okay. Then you have any short-term investment to be added in. Then you also have your cash equivalent. Okay. Now, for your operating activities, you know, there are two things that is quite important after you have gotten your cash flow from operations. You know, we said interest paid and tax paid. Okay. Now, let me show you that pro forma again before. Can you see it here? So the interest rates, the interest paid and tax paid, because money has gone out, is going to be removed. So you have to adjust for that. So you come to your interest liability brought forward from last year. Then you go to the statement of profit or loss, or the interest that was paid. Then our finance cost that was charged in that year. Then you have to take a look at your interest paid at the end of the current year. Okay, so you have this figure. So the difference between what you have at the beginning and what happened during the year will now give you your balancing figure. That's the interest liability that goes into your cash flow. Okay, so the same is applicable to tax paid. So you bring on your tax liability from last year to be both current and deferred tax from last year. Then tax charge for the year. That's what you bring on here. If there is any deferred tax or evaluation of PPE, you also bring it on. Then what was the tax paid this year? Okay, so the difference between all of that will give you your liability for the current year, which is your balancing figure. Okay, so that's what happens around that. Okay, so interest. So let's take a look at interest and dividend. Okay. Now, dividend are normally shown in the under the financing activity part. That's dividend paid. Okay, so you can decide to put it under what's it called? Financing activity. But some quarters can also say operating activity. So whichever way you are choosing, just stick to one. Okay. Now, in my investing activity, you know, we said what relates to property. Okay, cash paid for property, cash received on sale, cash paid for inventories investment, not inventory. Inventory is an operating activity item. So cash paid for investment, okay, that'll be in or loans to other entities. Then dividend received on investment, dividend paid under the financial activity, then dividend for investing activity. Now for your PPE, all you need to do is bring on your balance at the beginning of the year. Is there any addition? That means I purchased more. Is there any revaluation? Disposal will be removed. Depreciation will be removed. Okay. So whatever you have here will represent your cash flows when it comes to PPE. Then for your financing activity, you know, we said it relates to shares. Received from issuing of shares. When I issue shares, did I receive money? Received from issuing debentures, long-term, bonds and all of that, overdrafts. Overdrafts will form part of cash and cash equivalents, okay? Because it's part of my demand deposits, okay? So, but for long-term borrowing, like debenture, loans, bonds and likes, forms part of receipts, form part of my financing activity. Then if I make any repayment on lease, okay, or amount borrowed, okay, on loan, then it also forms part of my financing activity. Then for the lease paid, I also bring on my liability from last year. That's both current and non-current. Do I have any lease addition? Okay. Then lease paid for the current year, then to give me this balancing figure. Then the same thing with dividend paid. Okay. So dividend is a family of actually retained earnings. Okay. So I bring on my retained earnings from last year, then profit for the year, then the difference between that and dividend paid for this year will be my retained earnings. So that represents my cash flows. Okay, So I'm going to take a look at the question because of time, and so that I can also talk a little bit on what's it called, financial instruments. Okay, so let's look at this question to demonstrate a little bit of cash flows. So we have this information that I was given. Let me see. Okay, so we're given additional information. It said on October 1, 2022, Hollywood issued 60,000 shares at a premium of 100%. The proceeds were used to finance the purchase and cancellation of all its 10% loan notes and some of its 5% loan notes, both at par. A bonus issue of 1 for 10 shares held was made on 1st November 2022. All shares in issue qualify for bonus. The current asset investment was 30-day government bond. Non-current tangible assets include certain properties that were valued at the start of in the year. Non-current tangible assets disposed in the year had a kind amount of $75,000. Cash received on disposal, cash received on disposal was $98,000. Depreciation charge for the year was $87,000. Okay, the accrual balance includes interest payable of $33,000 at September 2022 and $6,000 at 30th September 2023. Interim dividend paid during the year were $53,000. Required prepare a statement of cash flows for the year ended 30th September 2023, an analysis of cash and cash equivalents. Okay, now, so what do we do here? You go straight to your working notes. You start from your cash flows from operating activity. You adjust for your profit. So obviously, if the examiner is silent, use the indirect method. Okay, so now you go straight to your your working note and do the adjustment for your tax paid and interest at least. Okay, then you do your PP and all of that. So let's find out. So now, you do your movement in accrual. So in your accrual, that's the interest paid. So what happens here? So let's look at the question. So we were told that if I go into the account, so let me go and pick up you go to your balance sheet to check for accruals. Can you see now? So this year, let me check. Okay, so this year I have 36 and I have 33 last year. Okay, now I bring on my accrual 36 this year. Is that okay? Then in the in the account or additional information, we were told that for this year again, 6,000 is standing as my accrual. So you are going to remove it because the difference between the two will represent cash flows. So that's how we have 30 here. But for last year, if you look at the account here, sorry, where's the, okay, it's just 33. And it didn't tell me what happened this year. Okay, so I assume it's still that 33. That's how you have 0 here. Then for my interest paid, the interest liability is 33 from that note. I will now go into my account to check for my finance cost, right? So where is my, okay, I have 19 as my finance cost. Finance cost is also interest. So that's how you have this 19. Then at the end of the year, the current year, my interest is 6. Okay, let me see that. The additional information. So my interest is 6. Interest payable is 6. Okay, so that's what happens at the end of the year. So the difference between 33 plus 19 and you remove 6, it will give you 46. So that's the balancing figure. So you are doing for your accrual, your interest, then tax paid. The same procedure. What happened last year? What was I bringing on last year? So let's find out my tax in the accounts. Let's see my tax in the account. So this is it. That's how we got that 90. So 90 last year. Okay, so that's how you got this 90. Then how much did I charge in the current year? Okay, so I go to my SF profit or loss account to get my taxes. He said income tax expense is 104. So that's how this 104 was gotten. Then what's the position of my tax paid at the end of the year? I go to my account again. That would be my balance sheet. It said 100. Did you see that? So you just pick it up. So that's the 100. So the difference between 90 plus 104 and 100 will give me 94. So that represents my cash flows. So it's about looking at the balance last year, what happened during the year, then you compare with the balance at the end of the current year. Okay, so it represents your cash flows. Then I do my PP. You know, I've told you, you bring on balance of PP from last year. Do I have any addition? That means that I purchased PP during the year. I put it there. Is there any revaluation? I put it there. Is there any disposal? It will be in jacket. Do I have even deferred tax on revaluation if I'm giving? Okay. Then depreciation. Okay. Then you now look at the position at the end of the year. So the difference between all those elements is my balancing figure. So let's find out. So I go to the account to check for my PPE. Obviously, it's going to be in my balance sheet. So last year it was 510. Can you see that? So you bring on the 510. Then did I revalue? Did I revalue? Okay. Yes, I revalue. Can you see revaluation surplus here? 50. So that's how this 50 was gotten. Did I dispose? I will check the additional information. So once you know the principle, that's how you approach the question. I check my additional information. Let's find out whether we dispose. Said non-tangible assets disposed for the year at the kind amount of 75. Can you see that? So that's how you got this 75. Is there any depreciation for the year? It told me it said 87. Did you see that? That's how you got this 87. Okay. Then I will now go for the balance at the end of the year, 2013. So I look at my balance sheet again. It says, let's see that. It said 634. Okay. So that's the balance at the end of the year. So that's how I got this 634. So the difference between, by the time you net it off, will give you 236. Okay. So that represents my cash flow. So that all goes into my statement of cash flows. The same way with my interest. Okay. The same way with my interest. So what was my interest in the account? Then I look at the finance cost. Then what happened at the end of the year? Then the difference is 10. So let's try to find out interest in the account. Let's see, interest receivable, we said 9. Can you see that? So that's how we got that 9. Then finance cost is 5, if you remember. Sorry, am I going to wrong place? Okay. Let's see. So this is the income from interest receivable. So that's how we got that 5. Then 4 at the end of the year. So I come back to the balance sheet. Where's the interest? Sorry. So this is the 4 here. Okay. So that's how I got that 4 here at the end of the year. Then the difference between them is 10. And that's all the adjustments you need to do. If you notice in the question, the examiner tries to give you caught you off guard. Information here might relate to what's it called, EPS. Okay. But I don't have to use that. Okay. I don't have to use that in my adjustment. I only use it when I get into my financing activity. Is that okay? All right. So from there, you can now go to your statement of cash flows. Okay. So you can go to your statement of cash flows. So you start from your profit before tax. You just pick it up from the question. Income from investment, interest expense, depreciation, then profit on disposal is going to be removed. It has a current amount of 75, but we sold it at 98. So that's profit on disposal. And the sale will be in my, what's it called? It will be in my investing activity. Let me see that. Oh, God. Sorry, that's a investing activity. Let me see, financing activity. Okay, yeah, investing, right? Where's investing now? Yeah, this is it. I got it. Investing activity. So purchase of current asset. You see that? That's and the sale. Yeah, I'm talking about the sale now. Can you see? This is a proceed. It will be there. Okay. So you just post all of that. The decrease in inventory. How did I know that my inventory has decreased? Can I see the question where the inventory is stated? Oh, let's see. It will be under my current asset, right? So this is my inventory. Last year it was 469. Now it is 420. Okay, so it has decreased by 40. So to be added. Okay, so decrease to be added. Okay, so increase in receivables. You also compare from last year to this year. Then the same thing with payables. The increase in sundry accounts, we already done that. So by the time you net it off, you get your cash generated from operating or from operations. Okay, then you now do your interest and income taxes. You have already done the computation. So that I can get net cash flows from operating activity. Then you now do for your investing activity. So it relates to non-current assets. So purchase of non-current assets, remember we did it in that working notes, proceeds and interest received. Then for investing activity, that is what that working note 1 is talking about. So proceed on issue of capital, it was 60. Let me show you that. So we issue what's it called? Share capital at premium of 100%. Okay, so that's what we have there. And then at redemption, we're going to have what's it called? Where's the redemption now? Okay, so we're going to have what's it called? 10% at redemption. Okay, now then we also have a 5% loan note. Do you get the point? Then we also have dividend paid. Okay, so we're also giving what's it called? Dividend paid. So my dividend, let me see in the accounts. Sorry. Okay. Okay, sorry, this is what I was looking for. Dividend paid is in working notes. Okay, so can you see that? That's 53. So that's how you got this one. So you net it off so that you can have your net cash used in financing activity. Okay. And once you do that, you just net it off. Okay. So for your analysis of cash and cash equivalent, because whatever figure you have there is what you are bringing on here. Okay. So you look at your cash at bank in 2013. You know, I've told you what is your cash and cash equivalent. Is that okay? So cash at bank is 75. I don't have anything last year. The cash in hand is already in the account. Then you bring on your short-term investment. Then there was an overdraft. I have withdrawn more than what I have, so it will be in jacket. So my total cash and cash equivalent is 132. Okay, and that's exactly what you have here. Okay, so take your time to look at that, and then sorry. So take your time to look at that, and then you have some other questions there that you have to also practice. Okay, so that will be fine. So that's all about statement of cash flow. So make sure you know that pro forma very well, so that when you see questions like that, just apply the principle and try to solve it. Okay, then from there, we move straight to the next section, which is financial instrument. Okay, so let's see how far we can go here, but obviously we needed to finish off. Okay. Financial instruments. A financial instrument is any contract that gives rise to financial assets of one entity and a financial liability or equity instrument of another entity. So when I have a contract that gives rise to a financial asset of one entity and the financial liability or equity instrument of another entity, then I will say that is financial instrument. There are three standards that are applicable to financial instruments. Three of them. Number one is IAS32, financial instrument, that talks about presentation, and it also talks about classification of financial instruments. Okay. Then number two is IAS7, that talks about disclosure. Okay. It's also financial instrument, but it talks about disclosure. Then IAS9, financial instrument, which is more popular, it replaces IAS39, that talks about measurements. Okay, so it talks about how financial instruments should be measured and recognized in the account. It talks about initial measurement and subsequent measurement. So obviously nobody is going to ask you that, but I can assure you that within your syllabus, IAS7 will not be tested. That's the disclosure. But IAS32, how to classify financial instruments into financial assets, financial liability, or equity instruments might be tested. Then a little bit or more of IAS9, will also be tested. Financial instrument recognition. Okay. So that is that. So let's take a look at what is financial asset. A financial asset is any asset that is cash. So if you have cash, it's a financial asset. Two, a contractual right to receive cash. If I have a contract or right to receive cash or another financial asset from another entity, that is a financial asset. Or I have a contractual right to exchange financial assets or liability with another entity under conditions that are favorable to me. So that is a financial asset. Or is an equity instrument of another entity. So if I invest in ordinary shares of another entity, it's an asset to me. That's financial asset. So you have examples of financial asset, for example, trade receivables, people buys from me on credit. So that's financial asset. Options, okay, investment in equity shares. So those are examples of financial assets. So you need to take notes in case the examiner decides to pick you up on that. Then a financial liability is any liability that, you have an obligation, a contractual obligation to deliver cash or another financial asset to another entity. So we have an obligation, a contractual obligation to deliver cash or another financial asset to another entity, or I can exchange financial asset or liability with another entity under conditions that are not favorable to me. If it is favorable, it is financial asset. If it is not favorable, it is financial liability. Or I will have to settle the entity's own equity instrument. So maybe I enter into a contract where I have to issue my own equity instrument. So that is financial liability. For example, you have trade payables, you have debenture, you have loans, right? Redeemable, what's it called, preference shares. So those are financial liabilities. So you need to understand that. Okay, now let's take a look at this illustration. This question says, identify which of the following are financial instruments. So when you think about financial instruments, think about three things: financial assets, financial liabilities, and equity instrument. Because we said financial instrument is any contract that give rise to financial asset of one entity and financial liability or equity instrument of another entity. Is that okay? So one here, he said inventory. Obviously, inventory is not a financial instrument, okay? Because it is a physical asset, right? And then I don't have any contract or right to receive cash, okay, or to deliver those goods. So inventory is not a financial instrument. Investment in ordinary shares. Oh, that makes sense. If I have an investment in the ordinary shares of another company, that's financial asset, okay? And that is financial instrument. Prepayment of goods or services. Prepayment. I have paid for goods, okay, but I've not enjoyed the service. Oh, it is not a financial instrument because future economic benefit will be received, will be the receipt of that goods rather than financial assets. Okay, so now liability for income taxes. Liability, did I have an obligation? It is statutory, okay? It is statutory rather than contractual. So obviously it is not a financial instrument. A share option, an entity obligation to issue its own share. That is financial liability. So this is a financial asset. So B and E are financial assets, all right? So that is that. So you need to be able to differentiate that. So like we said earlier, and we have established that IAS 32, financial instrument, deals with presentation, how to classify a financial instrument into either financial assets, financial liability, or equity instrument, whereas IFRS 9 talks about recognition, measurement, and recognition. So we are under IFRS 9 now, financial liabilities. Now, a financial liability are initially measured at fair value, okay? You measure them at fair value. It's usually the net proceed of cash received less any cost. And on subsequent recognition, financial liabilities can be measured at amortized costs, okay? It can be measured at amortized costs. When I say amortized cost, we have done it before under leases. Remember your lease liability table. That is exactly what we call amortized costs, okay? So when I have a financial liability, I will initially measure it at fair value, okay? Then I try to remove maybe the cost, issue costs, and all of that from that, so that it will be the initial or the net of cash proceeds. You know, financial liability is I'm collecting money. I'm issuing bond. I can issue bond. I collect money, so I have a liability. So I measure it at its fair value. I remove any other costs that have incurred. Then subsequently, it will be measured at amortized costs. Okay, now, so let's look at this illustration to demonstrate that. So now just note those areas that I am explaining. They are highly exact. So I'm just going straight to where, because I know you are reading a lot. You have so much to read. I can't take you every aspect of IFRS financial instruments. It's a wide standard. It's very straightforward actually, but it's a very wide standard. Okay. So, but I will just take you what will interest the examiner. Okay. So that's why you need to listen to me. Now, loan note is issued for $1,000. The loan note is redeemable at 1.250. Terms of the loan is 5 years, and the interest is paid at 5.9% per annum. The effective rate of interest is 10%. Show how the value of the loan notes changes over its life. So if I issue a loan note, I am collecting money. So that money I'm collecting under the loan note that I'm issuing is a liability, and that is the financial liability. Is that okay? So the first thing I do is to compute the fair value. I will initially measure at fair value. So if it is a loan note of $1,000, obviously that's a fair value. Then I ask, did I incur any cost? It did not tell me I incur any cost, so that is my fair value. Then subsequently, I will now measure at amortized costs. So what do we do? Remember that lease liability table. That's exactly what we have here. So we're going to look at the year. You know, I told you then that you have 5 columns, you can remember, under your IFRS 16. So you look at year, then you look at your opening balance, look at your finance cost. Did I make payment? Then balance at the end of the year. That's what we are doing. So if you look at here, what was the balance? It was 1,000 because I received 1,000. That's a fair value, okay? If there's any cost, I would have removed it. Then I charge 10%. How did I know that it's 10%? I said the effective rate of interest is 10%. Did you see that? Meanwhile, I will pay. Say the term of the loan is for 5 years, at interest is paid at 5.9. So that is a cash flow. That's a cash payment. Okay. So I will charge 10% on this. I have 100. Then the cash flow is 5.9%. So we apply 5.9% on 1,000, and we have 59. So I'll be paying 59 every year. So if I net it off, that means I'll say 1,000 plus 100 minus 59. It gives me 1,041. So this become my opening balance in year 2. I charge 10% again. I will also pay 59. I have 1,086. So that's what you do up to the end of up to year 5. So here he said it will be for 5 years. So that's how we got this 5 years. So when you bring on this opening balance, I also charge 10%. So the only difference here, is because I am paying, and it says it will be redeemable at 1,250. So that means I am paying both 1,250 and the 59 at the end. Okay. So if I net it off, it will give me new here. So my total interest has been 545. Okay. So that's the issue there. Can you see that? That's the issue. So if you now add it to that initial 1,000 that you collected, you have 1,545 at the end of the day. And that's how you do your financial liability. So take some 60 seconds to look at that table. Do you have any concern for me? Okay. Any question? Okay, so let's look at question 1 to continue our story. A company issues 5% loan notes issues. Okay, so you have to mind those sentences. At a nominal value of $20,000 with an effective interest rate of 5%. Loan notes are repayable at par, unlike what we did earlier at a premium. So at par, okay, for 4 years. What amount will be recorded in the financial liability when the loan note is issued? What amount will be shown in the statement of profit or loss and financial position for years 1 to 4? Okay, so what do I do here? Did I incur any cost? No. So he said, what amount to be recorded as a financial liability? So I have to do my table. Okay, so all you're going to do is, you do your table again. The opening is 20. You charge 5%. They told us it's 5%. Then how did we get this 1,000? Now listen. Now for the interest, where's the question? For the interest, it said 5% loan notes at a nominal value. So you apply 5% on that loan note. That's the interest you are paying. Okay. Then you will now compute your amortized cost using the effective interest rate. So it's just a coincidence that both of them are 5%. So you need to understand that. Okay. So that's the 5% you also have here. That's effective interest rate. So when you net it off, you have 20. You see? You carry that 20 here, you net it off. So throughout the 3 years or 4 years, you have 20 until the end of the year, when it will now be redeemed at par. Okay, so that you can have a 0. Now, in your account, so when the money comes in, you debit your bank because money is coming in, and you credit loan notes as a liability. So year 1, year 2, year 3, year 4, you'll be showing the interest. Okay, what's it called? The finance costs. Yeah, that's the interest. So in year 1, I will show, this is my year 1. Look at my year 1. So I'll just use this as an example. So this is my year 1. So when I'm in year 1, I will show this closing balance as non-current. Okay, I'll show it at non-current because I will pay it at the end of the 4th year. Do you get the point? Now, in year 2, okay, I will also show this as a non-current in year 2. Okay, it will be non-current in year 2. Then in year 3, it will not be current because it will be due in year. It will not be current in year 3 because by year 4 I would have paid it. So that's why you have 0 here. Then current liabilities, it becomes current liabilities in year 3 because to be paid, at the end of or even before year 4. Okay, so that's exactly what they have done there. So you have a quite number of questions here. Just take a look at them and look at what was done. It's very straightforward. So that's what you need to understand. Okay, I think let me show you what question is this. Okay, let's look at question 2. Okay, so that I can show you how to do the fair value. I think that one has issue costs. So let me, where is that? I think I saw it now. Let me see. I'm not sure. Okay. Oh, okay, yeah. It's question 3, not 2. I was reading question 3. He said a company issues, did you see? Issues financial liability. 4% loan note with a nominal value of 20,000. The loan notes are issued at discount. That's one. And there's an issue cost. Did you see? That was incurred. So when you want to do that, you have to remove it. Okay. So this is it. So the loan note was 20. Then it was issued at the discount of 500. The issue cost. So this is this is what you are taking into your lease liability table. Can you see? Unlike the question we did earlier, there was no cost. So that's what you are taking to your lease liability table. So please take note of that. Okay. So we have done something similar, so we don't really have Okay. Now let's take a look at preference shares. Now, if I have, preference shares, that's preferred shareholders. Okay, you also pay interest on preference shares. You only pay dividend for shareholders. Is that okay? Preferred shareholders. But if I have irredeemable preference shares, that means my irredeemable preference shares contains an obligation to make payments. Okay. They will not be classified as equity. If I have irredeemable preference shares and it contains an obligation to make payment, that means a moral compulsion. Okay, that is not equity. But if I have irredeemable preference shares that has obligation to deliver or to make payment, either in capital, dividend, or interest, they are classified as equity. So if preference shares are redeemable or have a fixed cumulative dividend that that I'm going to pay, so that's a financial liability. So you need to understand that. So preference shares, once I have the contractual obligation to deliver cash, okay, even though it's irredeemable, okay, they are classified. Once I don't have it, they are classified as equity. But once preference shares is redeemable and I needed to pay, that's a liability. So the key element is where there is an obligation. Is that okay? Now, for interest, now listen, interest and dividend, it depends on the treatment of the underlying instrument. The issue now is this: if equity dividend declared, if they are declared, right, they are reported in the equity. So equity dividend declared are reported in equity section, but dividends on instrument classified as liability are treated as finance cost in my statement of profit or loss. Now listen, let me say that again. If I have dividend, okay, the treatment of that dividend will be dependent on the treatment of the underlying instrument. Dividend can come from preference shares and all of that, even interest, okay? They are the same. So if, for example, I have equity dividend declared I have already declared it. Is that okay? I'll take it within my equity. Okay. Then dividends on instruments that I classify as a liability, I'll treat it as finance cost in my statement of profit or loss account. Now, let's take a look at this question. On 1st April 2007, a company issued 40,000 redeemable preference shares. It is redeemable at a coupon rate of 8% at par. Now, they are redeemable at a large premium that gives them an effective finance cost of 12%. How would these redeemable preference shares appear in the financial statement? I will also do my, my table. Is that okay? You bring on your 40 here. You know, it's at 40. You can see at 40,000. Then you charge the finance cost. It says 12%. How much am I paying? 8%. 8% of 40 will give you 3.2. Then you net it off, you have 41. So that's what you do for those two. Okay? That's what you do. So how do you now represent it in your account? Then that means when I'm in what's it called? In 20x8, which is year 1, I will represent this 461 as a non-current liability. Is that okay? Then this in 2019 as is also as a non-current liability. Then in my account, statement of profit or loss, this 480 goes there, then 4992 goes there. Is that okay? That's what the examiner is asking you to do. Then how do I know classification of as liability or equity? Now, if you have a financial instrument, or let's say financial liability, or let me call it financial instrument, how will I know? You know, asset is quite straightforward. No, we have said it. Either to classify it as liability or equity. Okay, it's going to be dependent on the substance of the financial instrument. Because sometimes some financial instruments, you know, might have a legal form of equity, but in substance, economic reality, they're actually a liability. So the point is, we need to be sure that do we have any contractual obligation to deliver cash or issue our own instruments. In that case, it's going to be taken as financial liability. Okay, so that's the issue there. Now, let's now take a look at compound instruments. I'm not sure the examiner will bother you here, but let me explain it, okay, in case you were bothered. Compound instrument is a financial instrument that has a characteristic of both equity and liability. So if I have, for example, convertible loan, once you see in a question, you're giving convertible loan, that is compound instrument. It has the feature of an equity and the liability. So the issue now is this. It means that if I have a convertible loan, okay, there's a liability or the debt element that the issuer, you know, the person that is issuing it as a company has potential obligation to deliver in cash. Okay, so that's the debt because they convert, you know, loan is debt, right? Normally, if I take loan, for example, then I need to repay the loan. But if I have convertible loan, that means I may decide not to take cash. I want to convert it to shares. So that's a compound instrument. So I have an obligation to deliver cash, or the equity element is that the investor may choose to convert into shares. So that is what we call compound instruments. All right. So now the issue now is you need to separate it on the account, the liability element and the equity element. Okay. Now on initial recognition, you also measure at fair value. Then on subsequent recognition, you measure at amortized cost. It's just what we have been doing. Okay. So the only thing is, once you measure at fair value initially, you now take it as amortized cost. Whatever balance you have when you do your amortized cost is your liability. You will now remove the cash proceeds that you have received from that liability. Whatever balance you have is your equity. So let me go to a question straight up. Convert issues convertible loan. Did you see that? Okay. So you need to take notes. That pays interest of 2% per annum in arrears. The market rate is 8%, being the interest for equivalent debt without conversion option. Now, the loan of 5 million is repayable in full after 3 years or convertible to equity. So I can pay the loan or I can convert. Meanwhile, the effective interest rate I will use is going to be interest rate without conversion, which is 8%. So we're giving a discount factor. So now, how will it look like? Okay, so what is the cash flows? So let's find out what is the cash flows in this question. The loan is 5 million, right? Okay, the loan is 5 million and 2% per annum. Okay, so that's my cash flow, 2% of 5 million. So that will give me 100. Is that okay? Then I've already been given discount factor of 8%. So I bring it to, if I discount to present value initially, okay? So I bring on the 100 again. The cash flow is 100. Then in year 2, okay? Now this is not amortized cost, so listen up. That initially, it has to be discounted to present value. Is that okay? Because it's a convertible loan. So that's what you're doing here. Then at the end of the year, I will pay both the principal and the interest. Is that okay? So that's how you have 5-1 here. You also discount. So what I have here is my debt. Can you see? That is my debt. So now that debt, I'll now have to split it. You know, I already received the cash. I'll now have to split it between debt, which is liability, and equity. I already got the figure for my debt. That's the present value of the convertible loan. Then how much is the cash received? 5 million. So the balancing figure, which is 772, is the equity element. That has to be shown separately on the account. Did you see that? Before I can now go to my amortized cost. So you now bring on this debt and do your amortized cost. Can you see? So this is what we are used to. So I charge 8%, then 2%, that's the 100 cash flows, and on like that. So that is what you do. So you can look at other questions to demonstrate. That's what they call compound instruments. They have the feature of both equity and liability, and you need to split it. Is that okay? Now, so we have done financial liability and equity instruments. So let's take a look at financial assets. Now, you can only recognize financial assets if an entity becomes a party to the contractual provision of the instrument. You know, I've told you what financial assets is all about, if you remember. Cash and all of that. Now, equity instruments, you know, financial assets are initially measured at, what's it called? Fair value, okay? They are initially measured at fair value, okay? Now, for equity instruments, that means I bought an equity instrument from another company. It is an asset to me. Does that make sense? So I will initially measure it at fair value, okay? Then I can now decide subsequently to either measure it at fair value through profit or loss, or fair value through other comprehensive income. Okay. Now, so you either measure it at fair value through profit or loss, or fair value through other comprehensive income. Okay. Now, normally, every financial asset are measured at, or equity instrument. If it is an equity instrument, financial asset, that's an equity instrument. That means I purchase the ordinary share or equity instrument of another company. So they are naturally measured at fair value through profit or loss. So what it means is any transaction costs associated with that purchase will be expensed. Okay, it will be expensed. They are not included in the initial value of that asset. So that investments are then revalued to their fair value at the end of the year. Is that okay? So that is it. Now, but when it comes to fair value through other comprehensive income, remember, let me break down again so that we understand. We are talking about financial assets. IFRS 9 says an entity will recognize financial assets only if and only the entity as a party to the contractual provision of the asset. Is that okay? initially, financial assets, let me say equity instruments, are measured at fair value. Then subsequently, you can decide to measure at either fair value through profit or loss or fair value through other comprehensive income. Naturally, most equity instruments or financial assets has feature of fair value through profit or loss. So they are using fair value through profit or loss, that transaction cost will be expensed. Then that investment will be revalued to its fair value. And any gain or loss will also be recorded in profit or loss. But if my equity instrument is now held at fair value through other comprehensive income, transaction costs will be capitalized. So that means it will be added as part of the cost of that investment, okay? Then that investment also will be revalued, at the end of the year with any gain or loss recognized in other comprehensive income. Is that okay? So that's the difference. So you need to understand that. Now, for debt instruments, okay? For example, bonds, redeemable preference shares. What we did earlier, equity instrument is shares, which is a financial asset. But if it is a debt instrument, I invested in debt instruments, for example, bonds, redeemable preference shares, and the likes. I can measure it in three ways: either fair value through profit or loss, okay, or amortized costs, or fair value through other comprehensive income, okay? Okay. So either fair value through profit or loss, amortized cost, or fair value through other comprehensive income. So they have debt instrument. Okay, now, but before then, normally, those debt instruments will normally have a fee of fair value through profit or loss. But before you can now do amortized cost or fair value through profit or loss, amortized cost or fair value through other comprehensive income, you need to check your business model test, okay, the contractual cash flows. The business model test will look at the entity's purpose. What's the purpose of me holding that instrument or the debt instrument, for example, all right? Then the contractual cash flows will look at the cash that will be received as a result of holding the instrument. So the question is, what's the purpose? Am I holding it for trading, or I just want to invest, then I get a cash flow later in the future? Now, for an instrument to be carried at amortized cost, it must pass the two tests. That's your business model test and the contractual cash flow characteristics test. So the entity must intend to hold the investment to maturity. So that's the business model test. Before I can classify it as amortized cost, I have to hold it to maturity. Then contractual cash flow is that the contract terms of financial asset must give rise to cash flows that are solely of the principal and the interest. Okay, so if I now take it, if I pass those two tests, that means I will hold it to maturity, then the cash flows will be the principal and the interest that I'm going to receive at maturity. Then I can now apply amortized costs, okay? And our interest rates, the interest income, you also use your amortized costs, your effective interest rate. Is that okay? Just like we have been doing. But in this case, to be cash received because I'm not paying. So it's the interest income, then cash received, so that I can know my balance. Is that okay? Now, if it is fair value through other comprehensive income, so I also have to check those two tests, the business model test. That means the entity must intend to hold the assets or the investment to maturity, but they can sell if the possibility of buying another asset with a higher return. So I have to hold it to maturity, but I can decide to sell if there is a possibility of buying another asset with higher return. So that's the difference between amortized costs and fair value through other comprehensive income. Then that cash flow will also be both the principal and the interest just like we have in amortized cost. So the only difference is I can decide to sell. I have the possibility of selling before maturity with another, if I have the possibility of buying another asset. So if a debt instrument is now held at fair value through other comprehensive income, that asset is initially recognized at fair value, okay, plus transaction cost. Remember, it's only if you are taking it as fair value through profit or loss that transaction costs are expensed. The interest income is calculated using effective interest rates, like we have seen. Is that okay? So you have further details there that you can check. So let's look at this question. The company invests, did you see? Invests $5,000 in 10% loan notes. The loan notes are repayable at premium after 3 years. The effective interest rate is 12%. The company intends to collect cash flows, which consist of solely the principal and the interest capital, and are therefore choosing to record the financial assets at amortized costs. Did you see that? So that test has been passed, so they can decide to do it at amortized cost, because the business model test says you have to what's it called? You have to hold it to maturity. Is that okay? And the contractual cash flow says you are only taking both the principal and the interest. Okay, so let's look at what you do then. So all you're going to do is to do your amortized cost. So, but in this case, it will be investment income. So how did you get the 12%? We look at, let's see, on the loan, the effective interest rate is 12%. Can you see that? That's the income that is coming to me. Then the cash received is 10%. What is that? On the loan notes, can you see? 10%. Okay, so you do that. That's exactly what you're doing. Then you show it in your account. So that's what we call debt instrument. Okay, so you can take a look at some other questions that are there. So you just apply the same principle, okay? The same principle, okay? So I don't think the examiner can bring you up more than that. The other aspect is factoring of receivables. I'm not sure they can ask you factor. Even at the higher level, they don't do that, okay? So make sure you know the little I've been able to take you around IFRS 9, financial instrument, know the accounting treatment. Make sure you practice your amortized cost properly, you can see, and then make sure you're able to explain one or two stuffs that you are being told in the question. Thank you so much for staying with me, and I wish you the very best in your exams. So anytime you have questions, please feel free to ask me. I'll be glad to answer. I wish you the very best. Then for your mock exams, I'm going to send it to the group by next week, okay? So make sure you also take a look at it. Thank you so much. Have a wonderful night rest. Good night.